Are you just getting started in investing or looking to expand your portfolio? In this video, I'm going to show you how to invest in the S&P 500. The S&P 500 index tracks the 500 largest companies in the United States. You can't invest in the index directly, but you can through either individual stocks or index funds such as mutual funds or ETFs. It is one of the most widely used indicators of the overall health of the US stock market. The index is market capitalization weighted, which means that the weight of each company's stock within the index is determined by its market value. Companies with larger market capitalization have a greater impact on the index's performance. For example, Apple and Amazon stocks are around 1 to 8% of the index. The weight of some of the smaller companies in the index is around 0.01%. The 10-year average annual return has been around 10.5%, as you can see on this graph. I'll also link this in the description below. You can also go to this webpage here, which shows you the companies by index weight. I'll also link this in the description below. So, how do you invest in the S&P 500? The first step is to think about your investment strategy. Why are you investing? How long do you want to invest for? And how much risk are you willing to take on? If you think that the S&P 500 fits into your overall investment strategy, then the next step is to open an investment account. The investment account could be a retirement account, such as a traditional or Roth IRA, or an employer-sponsored 401k or similar, or a taxable brokerage account. There are many brokerage firms to choose from, such as Vanguard or Fidelity. The third step is to fund your investment account. Money can be transferred from your bank account or via a check to your brokerage account. You also need to determine how much money you want to invest. The fourth step is to choose your investments. Do you want to invest in individual stocks included in the S&P 500, or do you want to invest in mutual funds or ETFs that replicate the S&P 500? Mutual funds track most, if not all, of the stocks of the 500 companies from within the S&P 500. They try to match the performance of the index as closely as possible. ETFs allow investors to pool their money in a fund made up of stocks, bonds, and other assets. They're traded like stocks, which means that their share prices can fluctuate throughout the trading day. Then there's individual stocks, which is an alternative way of investing in the S&P 500. So this is buying and owning individual shares of companies like Facebook, Apple, or Amazon. So you're probably wondering, what are some of the differences between mutual funds and ETFs? One of the first differences is cost. Some mutual funds, especially actively managed ones, may have high expense ratios due to the costs associated with active management. ETFs often aim to passively track an index and tend to have lower management fees. The next is investment minimums. Mutual funds will usually have a minimum amount to invest. For example, Vanguard requires a minimum amount of $3,000 to invest. ETFs can be purchased in single shares. The next is liquidity. When you sell mutual funds, they usually take 1 day to clear, whereas when you sell ETFs, they usually take 3 days to clear. There's trading flexibility, so the prices that you buy and sell the mutual fund will depend on its value at the close of a stock market, whereas ETFs, you can buy and sell them at specific prices when the stock market is open. And the last is tax efficiency. So mutual funds are generally considered less tax efficient because they may generate capital gains, whereas ETFs are generally considered more tax efficient. The fifth step is to buy your investment. Once the funds in your brokerage account have cleared, you can purchase funds from the S&P 500 in just a few clicks. You simply need to search for the stock, ETF, or mutual fund by its name or ticker symbol. Here is an example of a ticker symbol of an ETF, which usually contains 3 symbols, and a ticker symbol for a mutual fund, which generally contains 5 symbols. So, if you want to buy the S&P 500 mutual fund, after you select the mutual fund that best suits your investment goals, you just follow the platform's instructions to make the purchase. The price of the mutual fund will depend on its value at the close of the stock market. As I said before, mutual funds have investment minimums. However, once you have purchased the minimum amount, then you can invest however much you want in the future. If you want to buy the S&P 500 ETF, you can buy a single share of the S&P 500 ETF or multiple shares. When buying ETFs, you have two options. You can either choose a market order, which means that you'll purchase the fund at its current price, or a limit order, which lets you set a price which the trade will be executed if the fund hits that price. ETFs can be purchased at specific prices when the stock market is open, which is 9:30 a.m. to 4 p.m. Eastern Standard Time. ETFs don't have investment minimums required beyond the price of the one share. The last is to buy individual stocks within the S&P 500, which can be purchased at the share price. For example, if you have $400 to invest and a stock's share price is $100 per share, then you can buy 4 shares. After your trade is complete, you are the owner of the shares of the S&P 500. The last step is to set up automatic recurring transfers to your brokerage account. This can be a great way to grow your net worth over time. If you're interested in the median net worth of America's upper, middle, and lower classes, please click here. Are you still wondering if you should invest in the S&P 500 with mutual funds or ETFs? The answer really depends on your individual preferences, investment goals, and circumstances. One of the main differences, as I said before, between ETFs and mutual funds is that ETFs tend to require a lower minimum investment amount. Therefore, if you're a new investor without much capital to invest, ETFs may be what you are looking for. Remember, it's always a good idea to consult with your financial advisor or do thorough research before making any investment decisions. If you want to get notified of our future videos, please click on the subscribe button. The next question people ask is, what are the lowest S&P 500 index funds? These are the lowest funds at the moment. So as you can see, the Fidelity Zero Large Cap Index has an expense ratio of 0%. Now, before you start investing in the S&P 500, I'm quickly going to go over some of the pros and cons. So some of the pros are that you're exposed to the 500 leading companies in the US. There's a history of high returns if held long term, although this is definitely not guaranteed. It allows investors to passively invest with index funds. It instantly diversifies your investment portfolio, and there's no research or prior investment knowledge required. And some of the cons are, it's weighted heavily towards some of the larger companies. There's no exposure to small cap companies, and small cap companies can produce high returns. There's no exposure to international companies because it's all US companies. There's significant short-term volatility, so you've got to be able to handle those ups and downs. And as I said before, returns are not guaranteed. So, is investing in the S&P 500 a good idea? Although the S&P 500 and the stock market in general has historically rewarded patient investors who buy and hold for the long term, its performance cannot be guaranteed. It's best to consult with your financial advisor to determine if the S&P 500 is right for you. Happy investing, everyone.